Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at MU, or Micron Technology Inc. MU is an American producer of computer memory and computer data storage. Here's the barchart.com technical opinion rating for MU. The bar chart rating is a 100% buy with a strengthening short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. The market is approaching overbought territory. Be watchful of a trend reversal. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that MU is well above the moving average line, so the monthly trend in MU is up. Next, we're going to look at a daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend in MU is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel, or even below the Keltner channel, is fine. The MU stock price is below the upper Keltner channel line, so MU is inside the buy zone. Since the trend is up, we want to buy a call. MU has plenty of option chains to choose from. We're going to use the July 19 option chain. Right now, the July 19 options have 61 days to expiration. Here is part of the MU option chain for July 19. MU closed at 125.29 on Friday. That means any calls on the list from 80 to 125 are in the money. Let's take a look at the profit potential for purchasing the 125 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 125 call is 985 to 995. We tried to enter at the midpoint, so we'll use 990 as the buy price. Our call option calculator shows the profit potential for this call based on MU price changes at option expiration from flat to a 12.5% increase in price. We can see that if the MU stock price is flat at 125.29 at option expiration, the 125 call will lose 97.1% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the option we buy to break even and start profiting. Whoops. Now let's take a look at buying the 110 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 110 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the MU stock price is up 1%, the 110 call will lose 13.6% of its value. We want that to be break even or better, so the 110 call does not meet our requirements. Let's see if the 90 call will work. The bid-ask spread for the 90 call is 36.25 to 36.85. We tried to enter near the midpoint, so we'll use 36.50 as the buy price. The 90 call works. If the MU stock price is up 1%, the 90 call will make a 0.1% or a $4 profit. That's better than break even, so the 90 call is the one we'll buy. The call option purchase calculator also shows that if the MU stock price increases by 2.5%, the 90 call will make a 5.3% or $192 profit. If the MU stock price increases by 5%, the 90 call will make a 13.8% or $505 profit. If the MU stock price increases by 7.5%, the 90 call will make a 22.4% or $819 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice, that if the MU stock price does not make the expected move up and remains flat at expiration, the 90 call would only lose minus 3.3%, or minus $121, compared to the 97.1%, or minus $961 loss for the 125 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the MU July 19 expiration 110 strike call and sell to open the MU July 19 115 expiration call. Sorry about that. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 110 call for $19.15 and sell the 115 call for $15.65. $19.15 minus $15.65 equals $3.50. So the entry price or debit cost for the spread is $350. The call option spread analysis calculator picture shows that the spread will make a 42.9% or $150 profit if the MU stock price declines by 7.5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect a $1,565 cash credit to our brokerage account for the sale of the 115 call. As we said on the previous slide, this reduces the cost of entering the spread to $350. Here's the note regarding earnings report. The next MU earnings report is scheduled for June 19. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the MU July 19 expiration 90 strike call for $36.55. Buy to open the MU July 19 90 strike call for $36.55. We also reviewed the spread. The spread said to buy to open the MU July 19 110 strike call and sell to open the MU July 19 115 strike call at a debit of $350. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.